Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, welcome to the latest edition of the ASB Investment Podcast. As always, I'm your host, Nigel Grant, and I'm joined here today by a man who will be familiar to many of our listeners, the BlackRock Investment Institute, or BII's Chief Investment Strategist for Asia Pacific. It's Mr. Ben Powell. How are you, Ben?
Doing really well, Nigel. Great to be back with you and the listeners. Looking forward to the conversation.
And obviously it's great to have you here. I imagine that New Zealand winter air feels pretty crisp compared to Singapore. How are things with you, and what have you been up to? And I guess from last time, cricket watching?
Yeah, living the dream. So, we can focus on cricket as much as you like. Be careful, because I will talk at length at that, probably more than is required. So I think I was last in around 6 months ago. From a market perspective, lots of focus, of course, on artificial intelligence and the kind of almost magic of the technology, I guess, that we're seeing there. Focus on central banks, geopolitics. 2024, I think, is the year of the most people going to the polls in human history or something. So it's been enough to keep us busy, Nigel, I think it's fair to say.
And I guess whether it's AI or central bank policy, is there, from when you were here last, is there anything that's changed in the average day for you? Like, are people asking you more or less, in terms of where your focus is at?
No, I think so. What's changed? I think it's Take That who said famously, everything changes but you. And so our Fed view has been the same for ages. Basically, we've had a view that inflation is going to be high and sticky for reasons we can get into if you're interested. So our view on the Fed has been that they might do a couple of cuts, right? Something like this.
By calendar year in?
In 2024, right? So that's been our view forever. Now, the market has whipped around incredibly, right? So you'll recall, Nigel, as recently as January, the market was implying nearly 7 cuts. So what's interesting is we've not changed. It's not us, it's the market that's really winging it around. So naturally, as the market has moved, our view is quite funny, Nigel. As a strategist, your view is either crazy or boring. So our view in January was crazy, that they weren't going to cut. And now the view is boring because the market has obviously moved much more in line with where we've been all along. So in terms of there's a lot of big stuff we can talk about, but I guess the Fed is front and centre. Our view is actually unch, but that has been more dramatic, I guess. It's been a more exciting unch than you might have thought, given how dramatic the market has whipsawed around. They're going to cut loads, they're going to cut nothing, and kind of given people concern, not because the Fed's changed, not because, in our judgment, anything in the underlying economic inflation reality has changed, but the market's views on that have changed actually pretty aggressively, and that's notable.
Okay, so speaking of that last October visit, and in general sweeping terms, I guess a lot of customers are asking us, has anything changed in BII, your economic outlook? And if things have changed, what is it?
I think one area that has changed is our view around the resilience of the US consumer. So we absolutely believe that increasing interest rates is important, but I think I would say we've been surprised by the resilience of the US consumer, and given the US consumer is around 70% of the US economy overall, approximately the health of the US consumer almost is the health of the US economy. And what I think has become clearer is the real bifurcation of the US consumer. So, frankly, if you've got debt, if you're an individual who's got debt, you've got credit card debt, you've got a mortgage, you've got a car loan, whatever, clearly interest rates hurt, and they hurt a lot. So I think that cohort of people have been impacted by interest rates in kind of the normal way. But what has been so striking is there's a meaningful cohort of maybe it's older people, but people who are lucky enough to have no debt, who are, it's kind of weird, are positively geared into interest rates, right? Interest rates go up, it means they get more income every month. So higher interest rates is making a certain cohort richer. So what that I think has meant is that the US consumer overall has been it's definitely nuanced, right? You need to think about it in more detail. But at the aggregate level, there's been more strength than I think many were expecting. So that's somewhere we've evolved. Where we're still very much the same is in this idea that inflation, we're in a totally different inflationary kettle of fish now than we were over the last 20 years or so, that period called the Great Moderation, where inflation was very low, very stable, We can get into it, Nigel, if you think the listeners are interested. But that's over, right? That is super over. Inflation is now, in our judgment, structurally higher. And I really want to emphasize, both of these are important. Structurally higher, that's very important, and structurally more volatile. So that should mean, that things are less certain looking forward. That should mean markets are more volatile. That has very, we judge, important implications for how you run a portfolio. And we can get into that. But the point at the moment, what has not changed in our view is the structurally higher and structurally more volatile nature of inflation, making, frankly, everything in terms of global economy, forecasting rates, forecasting markets a bit more challenging. How we navigate that, we think, is kind of very, very, very important.
Yeah, and we talked last time about one of the most powerful entities in the world being the bond market. But I've also never known a time where, you might have, but where monetary policy has been so in vogue for the average person. Now, they're not talking about what we're necessarily talking to that detail, but what's happening with rates. And the majority of people are obviously wondering when they might come down. There's that group that you talk about where actually I'm fine with high rates, no debt, gives me an income. But and you guys, I think, came out with the BII's weekly commentary this week, talked about, I think I saw a graph which was where ECB, US and another
UK. Nobody remembers the UK.
Right? Very, very important. Apologies to our UK fans. What's BlackRock's forecast in terms of, I guess, where things are going specifically around those three or rates in general?
So it seems to us that there's a clear desire from the central bankers from those three, let's pick those three, they want to cut. Right, this seems really clear. And so the ECB have kicked off the race amongst those three. And, if you could make a case that it's not the most obvious time to be cutting. Inflation is still high, doesn't look like it's coming down as much as they might have hoped for, but they just want to cut. So I think now the debate is very much moving towards how much these three central banks can cut and when they can cut. But the challenge at the moment, it seems to us, Nigel, is the data is not really playing ball in terms of giving them room for maneuver. So what we've moved to now is not perhaps an idea that we're going to see more hikes. The bar to that seems really high. They just
off
don't,
the table.
It seems to be really difficult. They just don't want to. Fair enough. But I think what we've moved to now is the idea that interest rates might be a bit stuck. Right? It's just harder for central banks to bring them down. So when we blend all that together, they really want to. Central bankers in those three key markets believe that policy is very restrictive. They believe that the so-called neutral rate is like 2.5, whatever, something like this. Yeah. So if you've got an interest rate at the ECB, Bank of England, the Fed funds, all different rates, but let's say 5, that's very tight. So they think that they can have their cake and eat it, I think, whereby they can cut rates a little bit and yet policy is still restrictive. That's their belief and that's the messaging they're going to give to us. But I think they do need a little bit more air cover, a little bit more support from the data, and then they can go. So our net is that you're going to see that it is cutting, but it's probably going to be de minimis. And so you might see a very shallow cycle, maybe 1 or 2 cuts prospectively through 24 and even beyond, and then maybe a wait and see thereafter. But I think that, like the old days of a big easing cycle, it's just really hard to see given the stickiness and kind of entrenched nature of inflation, or at least that's how it looks to us.
Well, do you subscribe to that sort of approach where you should be cutting before you need to?
We don't. So in the old days, during the Great Moderation, being a central banker was kind of super fun, right? Because inflation was no problem.
Yeah.
So you could kind of just think about your so-called dual mandate, put a line through inflation, right?
Just worry about employment.
And just worry about, so you're just a hero, right? So anytime things look a bit wobbly, superhero, central bankers can come in and save the day at the first sign of trouble because there was no trade-off, right? Now there's a trade-off. So let's run that through. So if you cut interest rates today, what if you lose control of inflation? So we have, it's got different kind of naming in different parts of the world, but something like the cost of living crisis is a real political and economic reality for many voters all over the world.
In the biggest voting year on record.
In the biggest voting year in human history. And inflation is as big an issue in the UK as it is in India, all over the world, right? People obviously, can I look after my family? How much do I get if I go to the do my weekly shop? all that stuff, right? So now, as the central banker, it's a much, much harder job. You've got risks on both sides, right? You have to care about both sides of your mandate, and therefore, I think it's very hard for you just to cut kind of, let's go for cutting because there's no downside. There's now a definite downside. If you cut kind of preemptively, whoops, we've lost control of inflation. That's got massive concerns.
And you don't want to be a central banker that lost control of inflation.
That's right. This is a very important point. So I think, central bankers, it seems to me, modern central bankers, their main sort of intellectual view is don't be Arthur Burns. So in brief, Arthur Burns was the Fed central banker in the 1970s, perhaps unfairly, but history has judged him as the guy who lost control and created the kind of 70s stagflation, high inflation and stuff. So all central bankers, I think have got something like a photo at home, like don't be this guy, right? So losing control of inflation is like the golden rule, like don't lose control of inflation. So actually, I think, and it's different for different central banks how they kind of balance this, but not being that guy. When I hear Chair Powell speak, I think that is really central to his mindset. So this idea of kind of preemptive cutting, just in case, I think is much harder now because preemptive cutting might make you Arthur Burns, which you really don't want to be. So it's hard. It's really hard.
Yeah, you can almost see them sort of go, we'll just do one, maybe two, and then wait. Have the winter off again and just sit. The BII has put out some recent, material on terms of different asset class views you have. In terms of equities or anything else you want to go to, I think if I recall, you still prefer US, Japanese equities as well over European. What is it about those markets and the companies that drives this view, or is there anything else?
So let's do the US and Japan, if that's okay.
Yeah.
So I'll give you the quick version. We can dive in if you'd like to. So the US, look, I mean, for better or worse, the US continues to be the center of kind of intellectual capital market development of the new technologies and therefore the new companies of the world. It's just a fact.
It's the way it is.
It's just a fact, right? So hey presto, here we are again with the AI revolution, which I definitely think has got implications for kind of life, the world, everything and everyone, but at the moment is sort of a US thing. So we've seen the AI megaforce continue, maybe even accelerate actually since we last spoke, Nigel, and that's been good. So on the Japan's different, no less interesting, but very different. Japan had 20 or 30 years of nominal GDP basically unchanged for like 20 years. It's actually quite incredible in yen terms. Now it's going up and to the right. So, statement of the obvious follows. That's a really big deal, a really big difference. And I still think many sort of market participants are very wary of, they're very cautious because fair enough, you've had 20 years of this not being true. Yeah. And there we are.
Or you got burned when it...
Exactly. So there's a Darwinian deselection. Anyone who's kind of believed in this may or may not be still in the industry in all candor. So the number of Japan kind of positively inclined investors over the last 20, 30 years has dwindled because that's been a tough trade, right? Yes. It's just been a very, very tough trade. However, it's just a fact, right? This is not just one man's opinion. It's a fact that nominal GDP flat for 20 years, now going up and to the right, a little bit like Andrew Lloyd Webber's love. That changes everything in our assessment, Nigel. So that's one. That's like the macro story, if you like. The micro story sounds boring, but is, I think, really exciting. You're seeing a corporate governance revolution where authorities are really encouraging, I could even say bullying, right? You've seen some extraordinary changes in a Japanese cultural context, a really kind of aggressive enforcement of obliging Japanese companies to treat their shareholders better. And this is happening, right? This is happening. So you're seeing, there's a few ways we can cut this cake, but for example, there's a history of having quite Byzantine cross-shareholdings, you own your mates' companies or whatever. You're seeing unwinds of that. You're seeing property portfolios get a little bit unwound. Japanese companies famously have got loads of cash. That's around half of Japanese, or even no debt, right? So half of Japanese companies, around approximately, are net cash. So, that sounds good, but as a shareholder, it's very inefficient. So what you're seeing now is the change of incentives is strongly encouraging Japanese companies, higher buybacks, higher dividends, and that is happening. So the macro story, kind of good, from flat GDP, nominal GDP to swiftly growing nominal GDP, and the sort of bottom-up revolution of companies treating shareholders much better. Both of those ongoing. And Nigel, to make your own point back to you, still it seems to me some fairly broadly felt skepticism. Again, I understand it, I get it, but it seems to us at the BlackRock Investment Institute that it is a different situation now in Japan, and one we're pretty positive on.
From those kind of asset classes, and particularly what's happening in Japan, to I guess the topic du jour at the moment for a lot of investors is AI, or artificial intelligence for those that AI hasn't informed you of what it means. This technology uses a lot of power. And for me, this is a critical megaforce. For me, this leads to two kind of critical questions. Is there enough power? And tackle whichever one you want. Is there enough? And also, what does it mean for one of your other megaforces, the low carbon transition?
So this is a great question. So artificial intelligence, it's a big deal. But I think we're moving from the wow moment. Like, the first time, at least for me, when I used a large language model for the first time, I was like, this is magic, right? It literally feels like magic, which is, awesome, right? So I think, but that, I think everyone's kind of had the wow moment now. Now we're moving, to your question, Nigel, into the much more practical, what does it actually mean kind of investment implications. And to your point, the implications for power are very clear. We're going to demand more power. These data centers, which are, you can think of as the nervous system or the brain of the artificial intelligence that we're asking questions for, they're hungry. They're hungry for energy. And I think what that's going to create is potentially a need for more power. So as an investor, what does capital do? It solves problems. Right? That's what we're for. So I think you are going to need a potentially kind of investment into power generation, power transmission, and all of that to feed the AI hunger. Also, electrification of everything, not to mention crypto. There's significant unrelated but overlapping demands for power. So yeah, I'd have thought over the years ahead, you're going to see this unexpected increase in demand, and that's going to raise a question as to whether there's enough supply. Price will signal that, right? So higher prices are a signal that there's not enough supply, and then all being well, capital markets can come in, speak to the problem, provide capital, provide the incremental supply, and earn a healthy return for doing so. That's how capitalism works, and I think that is going to be an opportunity for us as investors in the 1 to 3 years ahead.
And I guess it's when you say the demand for power, it's non-intermittent power, right? So what is it? So do you have a view on how it impacts that low carbon transition? Is the revolution delayed?
No, I think it's addition, right? So it's more demand. So I think the transition is ongoing.
Yep.
So we're seeing a multi-trillion-dollar investment over many decades, right? This is not all on day one, but I think the commitment you're seeing from global governments is approximately. Yes, you'll see a little bit of politics with net zero targets might be moved here and there. So for sure, it's not it's not a story without any nuance. But the commitment from the world's biggest countries to completely re-equip their energy architecture seems extremely clear and ongoing. So I think that story is still absolutely true and happening. And then on top of that, in addition to that, you're having this power demand, let's call it a surprise from AI, which is also going to be spoken to. So what does it mean? It means that I think power goes from being something that we don't think about, kind of just in the background, to something which is front and center from kind of every dimension. It isn't, if I can say just a transition thing, it's an everything thing, because if we have this big demand, increase in demand from, as I say, AI, maybe crypto, electrification of everything, then that may have societal issues, even problems about too much demand, higher prices that we're all going to have to be aware of, and we're all going to need to speak to in one way or another.
And I guess for me, looking at the markets as I do, you sort of see there's that first level impact, right? The tech stack, all the ones that build out the infrastructure, data centers, chip makers, obvious beneficiaries. Utilities have had a bit of a run in terms of that power thematic recently. In your view, whether it's a view that can be applied to New Zealand companies or not, but what other, I guess, what benefits of this are likely to trickle down to other areas of the economy? Do you guys have a view?
We do. So It's not the same, but I think the historical analogy of the internet is maybe helpful. So if you think about the internet, if we were having this conversation 30 years ago, 25 years ago, Nigel, we'd have been excited about Cisco and the hardware companies, right? So that, which would have been appropriate. And then what happened? Then what happened is over time, it moved from the foundational technology, the hardware, which now I guess is the chips, maybe the cloud services stuff. It moved over time towards, okay, but who can actually use this technology? Yep. So that's going to happen over time. So one area, of course, that we at BlackRock are spending a lot of time on is which sectors or which companies are kind of particularly ripe to use this technology. Because you'd have thought it's more applicable maybe if you're a white-collar worker, certain areas more than others. But if you're installing drywall, it's not as obvious that it's going to change your life that quickly, right? Yeah. So working through the kind of job level, task level implications, let's call it sector level, who can adopt this technology, driving efficiencies and creating positive earnings momentum, could be the next leg, as we saw over the 90s and into the 2000s with that productivity revolution. The technology enablers and creators, super important, right? It's not like I'm saying they're not important. They're very, very important. Obviously, they're very important. But I would have thought over time, as per the internet, you'll see an evolution, kind of the market excitement and enthusiasm evolve maybe from the adopters, maybe from the creators, the technology creators and producers, into, as we just talked about, the part of the supply chain which is necessary for this technology. That's the kind of power stuff we just talked about. And then maybe it's the
user.
Which companies, individuals, whatever, who can use this technology to become more efficient, which should mean for us as shareholders in those sectors or companies, higher returns, which is a good thing.
Yeah, because I always go back to the example for me. I don't know why it stands out, but Deere, right? I know you can't talk necessarily about individual stocks, so you move that tractor to be self-piloted, and that farmer can do other stuff. So, I guess you sort of looked at the first level thinking now is in the tech stack, it's going to replace. But is it going to replace jobs, or is it on a net basis, or is there other jobs that are going to be created?
So I think AI, it seems to me, is I'm one of the guys who thinks it's not just a normal technological deal. It's kind of a scale of fire or electricity, or
it's a revolution.
I really think it is, right?
A megaforce.
It's a megaforce. Yeah, we should call it a megaforce. Humbly, it's really unlikely that we, whether we're politicians or investors or just people on the street, I think it's really unlikely we fully understand the implications of this yet. It's just so huge, and it's happening so fast. As we say, humans struggle with the exponential, right? And these changes are happening so every day. You can read the paper and find another kind of wow thing, whether it's around kind of medical drug development or whatever. It's just incredible. So the implications, I think, are going to be very, very, very significant. I think this is going to be a question for governments all over the world as to whether we can have dynamic enough labour markets to adjust. Because, the optimistic view is, if we were just talking about the internet, if we were having this conversation 120 years ago, 50% of people worked in the fields, and now it's 2%, I think, or even a bit less than that. Yeah. So clearly the hope is that there are jobs that you and I can't even dream of that will be needed and will evolve. And that's what tends to happen, right? So there tends to be a positive kind of conclusion here, which is, hopefully as a kind of markets person, governments don't get too much in the way, and the market can solve by the creation of new jobs, new services that I'm not even clever enough to imagine, but they tend to turn up. The question with this one is it so fast and so broad that the transition, the job market transition is a bit quick, right? And it's very hard for people to re-skill quick enough to move out of some of the roles which are going to be complemented or heavily complemented, which is a polite way of saying replaced.
That farmer who used to plough the field could make the transition to working on...
Over decades, right? That happened over decades. Whereas now, I think the open question is, how quickly is artificial intelligence going to disrupt, in particular, some of these white-collar roles? So we're going to have to wait and see, but I would suggest all of us should be thinking about this, it seems to me.
And my final question I want to ask you was I was wondering whether people pay so much attention to perhaps the mega forces happening, but do they pay enough attention to what the future result of some of them might be? Or I guess, if they come to pass, what's the impact on rates and inflation?
So this is a hard question. So to your question on do we spend enough time thinking about the future, capital markets are a time machine. So the idea of capital markets is we try and think about the future and net present value that to a price today, right? So it's the beauty, again, as a kind of capitalist, the beauty of capital markets is it's a time machine where we are NPVing the future, right? That's the That's kind of the
net present value.
Net present value. Sorry, we're pressing F9 for those of you who are into F9. It's great. Now, I think so. Yes, we do spend a lot of time on this. Now, to your question on inflation, there's a kind of hope, and I get it, right? There's a hope that technology in general tends to be disinflationary, makes us all productive, makes us all kind of better at our jobs, and that might be true. But I think for AI, where I am at the moment is actually in the first instance, it could be inflationary. Yes. Why is that? Because power demand, it sounds very kind of prosaic, but copper. Like we need copper for the wires which go into the power generation and more transmission actually. But whatever. So the implications for like stuff, AI sounds like it's like science fiction, but it has practical physical implications for the world. And so you could see a bit of a positive demand shock for the stuff that's necessary. And that could actually be inflationary in the first instance. So, it's a hell of a hard question. But if you ask me, I think it's maybe inflationary in the first instance. And then all being well, we can get to the kind of technology productivity gains, which I think will happen, but that might be a couple of years down the track, actually, Nigel. So in the first instance, perhaps inflationary, which I don't think people really kind of get or understand as yet. And then, all being well, we come to the disinflationary kind of more pleasant bit, but not quite yet.
And hence that things may be a bit stickier than people think.
So the reason for inflation we think are the energy transition is happening, but rewiring the global architecture, it's a bit expensive, right? So that's one reason for sustained inflation. Two, demographics. It's not just China, but China, is a big deal. It was adding hundreds of millions of workers to the global labor force. China's now shrinking by 11 or 12 million workers every year, which is kind of amazing.
Extraordinary.
Yeah, kind of amazing. And then geopolitics, rewiring of supply chains away from where can you get it cheap to where can you do business with your mates. So those are kind of the three significant inflationary tailwinds. There's a hope that AI can kind of offset all of those. We don't think so, at least not yet. So inflation, we think, is going to hang around. Portfolios, therefore, need to be cognizant of that, and kind of over-worrying about inflation in your portfolio, we think is kind of a good idea at the moment.
Yeah, that technology is, as you said earlier, sometimes indistinguishable from magic, but that magic requires wiring.
So at some stage, I guess we'll move into, we'll you and I will upload our consciousness and whatever. But for the moment, we exist in a physical world, and AI, it is magic. I mean, it's amazing. For those of you who hadn't used it, give it a play. It is absolutely extraordinary. But it has profound, prosaic, very common regarded implications for copper, like as an example, and that's going to persist and is worth thinking about as an investment opportunity, we think, over the next year or two.
Well, thanks so much for your time today, Ben. I know you have a hectic schedule, so we really appreciate you making the time for us as always. I've loved the chat even more than I love the first chat. And I always love how you make these topics so enjoyable and easy to understand for people. My usual final question as we wrap things up. Last time you talked about one of your favourite cricketing documentaries. What's the next thing you'd recommend to listeners from a reading, watching or listening, or anything that you'd put on someone's to-do list?
So the AI revolution is so interesting, and I'm a sci-fi nerd, I'm afraid. Sorry for that, but I am.
Great.
So there's an amazing series of books called the Culture series, written by a Scottish novelist whose name is Ian M. Banks. And the Culture series is, I think, a really interesting kind of thoughtful, like, what could the world look like in 30, 50, for our children and grandchildren as these AIs kind of grow and become more normal, more commonplace in our life. Maybe there's robots. We're downloading AIs into robots. They're walking around. I mean, I know this seems unbelievable, but this is kind of happening, I think. So Ian M. Banks, his imagination and his ability to kind of think about that environment or that potential future, I think is absolutely incredible. So the Ian M. Banks series, the Culture series, first one is called Consider Phlebas. Mate, they're so good. So they're like,
awesome.
Yeah, they're so good. So I'd recommend those, I think.
So they're written recently, looking forward?
No. This is like all great art. Even it seems so fresh. So I think the first one was published in the early 80s.
Oh, wow.
No, his imagine. So, by the way, I kind of love this. So Elon Musk uses some of the characters from his books. So, when you see some of the rocket ships come down, they land on a drone ship called, Of Course She Still Loves You. This is named after one of Ian M. Banks's AI minds that kind of... So it is what a time to be alive, where you're seeing life imitate art in such a profound way. Anyway, so the world that some of the inventors are trying to create, you can read about in these books, and they're 30, 40 years old, but they still seem so fresher than ever, given what's going on, I think.
Man, I've got to add that to my list. So for me, avid listeners will know that I'm a bit of a gardener, and I've just popped into Hotel de Grant 2 climbing hydrangeas. Just go with me here. And I hadn't found them before, but I've added them to the portfolio for diversification reasons. I was consulting my book on hydrangeas the other day, as one does, and I found an apt description of what could be also applied to me and my out-of-work persona, and I quote, "The flower heads are untidy, yet attractive in a relaxed and naturalistic sort of way. They also smell good, especially in the evenings." So that could also apply to yours truly. I look forward to enlightening all of our listeners on how they go as we move into the springtime. So Ben, thank you again for joining us. I hope your travels, I hear you're flying out this afternoon to your next engagements, but thank you so much for joining us today. All the best for your travels home. And to you, our listeners, thank you for taking the time to tune in to us. We'll be back in a couple of weeks with the next edition. So until then, happy investing, and it's bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.